Good morning. Welcome to the Genghis Weekly Investor Briefing. We are glad that you have joined us today on the third edition of this webinar. And before I hand over to our team today, I'd like to introduce the speakers today. That is Churchill Ogutu, who is our head of research at Genghis Capital, and Gerald Morioki, who is research analyst. On how you can participate on today's webinar, as you look on your screen, there is a Q&A tab and chat tab, which you can use to project your questions to the panel as the session continues. And please feel free to use them to raise any question that you may have, and the team will tackle them at the end of the session. Over to you, Gerald.
Thank you, Daniel, and good morning, everyone. So in today's session, we'll go through a recap of the markets last week. So we saw the indices continue their rally for the second week. NASI was up about 5%, and then NSE20 was up about 4%. And this was amidst the earnings season. We saw a lot of companies rushing to report their half-year earnings. And generally, from what we observe, it's a dip in profitability. I think this was expected. But again, when you see the market rallying on earnings dip, then it begs the question of how the market was expecting the companies to perform. So I think given the rally amidst an earnings dip, generally it was positive. I think the market expected much worse than what the companies reported. And from the banking sector, was heavy on announcements. We saw banking sector generally announce drop in profitability, the magnitude of which was varied across most of the banks. So in terms of provisioning levels, I think that was the key item for the banking sector. Most of the banks chose to increase their provisioning significantly, but others were conservative. However, that still went into the bottom line performance. So turnover also increased about 39%, and foreign participation was about 54%. I think the previous week we were talking about 51%. It's actually a good thing, given that local investors are now participating more in the market. I think in the first half of the year, local investors were about 60. Foreign investors accounted for about 63% of the total participation. But now we are seeing more local participation, and this is a good thing. So last week there was a net outflow. I think in most of our briefings we are always talking about net outflows. So last week there was an inflow, but the key to note here was a large inflow in Safaricom that basically skewed the entire market's flows towards the positive side. So we cannot say that generally the market sentiment from the foreign side is turning, given that this was an inflow into just one stock. So again, foreign investors are still cherry picking. Safaricom for the second week, I think Equity Group for the first time in many weeks. And Equity Group came at a very low point. I think the price was about 28 shillings about 2 weeks ago. And this was a very attractive price for most of the investors. So the top traded counters are the usual Safaricom, GCB, ABL, and Equity. These are definitely the most solid stocks that you can invest in the Nairobi Securities Exchange. Yeah, so in terms of where we are trading at compared to our African peers, last week we went a bit into detail of the market PE, that's the second last column. This week we want to focus more on the last column. So in terms of PE, you can see that Kenya is at price earnings ratio about 9 times. So we are paying 9 times to the earnings of the entire market. And the African average is now at about 9 times. So we are trading at the African average PE ratio. So this is, to me, this is still a good price to get into the market, given that what is indicated in the last column, that is the dividend yield. It is above, our Kenya market is above the African average. So we are at a dividend yield of about 6.7%. And the African average is about 5.6%. So the dividend, you can look at the dividend just the same way you can look at the coupon you get on a bond. I think Churchill went into detail about the coupons and what you get from your investment in fixed income securities, and also what you also get from your money market fund in terms of interest or yield. So our yield is attractive, 6.7. The higher the yield by default, the better for investors. And when you look at most of the counters, especially in the banking sector counters, the yield is quite good. Some of the banks have yields that are above the risk-free securities. It's quite attractive for investors. So the market still offers quite attractive opportunities from where we stand. So trading ideas for the week. Long term, we are still biased towards the stocks with strong fundamentals. I think except for Safaricom, most of the strong stocks that we are seeing are still trading at very attractive multiples and price levels compared to their averages, historical averages. But for the trading ideas of the week, we have maintained the profit take recommendation on Safaricom. Last week, we talked about profit taking on Safaricom. We had expected the price to hit the resistance level of Kenya shillings 30, and we saw this happen during the week. In fact, it traded at a high of about 30.10, but 30.10, and we expect a lot of profit-taking investors to come at these levels. So the other key counter we are looking at is a speculative entry on Centum, trading at a very discounted price to book of about 0.3 times. And given that the business has been very vocal about measures that would ideally support its price, so that its price to book trades at about 1 times. It's one of the counters that investors could look at favorably. So remember that CMA in July, they announced some guidelines on share buybacks, and Centum has always talked about share buybacks as one of the ways to support the price. And the other key thing is approvals for the majority shareholder to add on to his stake. So these are the key things that the market should look at keenly on Centum as it trades at the 0.3 times book price level. So for corporate calendar, I think today is the last day for half year earnings season. I think I've seen today earnings from the Standard Media and Home Africa. So basically, at the end of the day, we should expect most of the companies to announce their earnings. So after that, now we are entering into a very quiet period, but still there is expected earnings from KPLC and Kengen. I think it's only last year they could not give their results on time because of the audit issues they had. But we expect them to give their results in October, as usually the case. So Safaricom is also expected to close the half-year period in September. So that will be key to watch for investors, especially in November when they announce their half-year results. So Churchill could take us through the macro and fixed income. Thank you.
Thank you, Gerald, and welcome everyone to this webinar. Let me share my screen. I'll first walk you through the macroeconomic calendar for this week before we get into the fixed income segment. So today's session, we're expecting a number of releases to be put out by the Kenya National Bureau of Statistics. The first one is the August inflation. That's on the year-on-year rate. The the graph that we have is the inflation trends all the way starting from January 2015 to last month. And just to focus on the latter part of the graph, particularly the last couple of months, what we have seen in terms of the headline inflation print is the disinflationary trend, whereby on a month-on-month comparison on the inflation data, we've seen that that trend has been coming down. And that is expected in the current environment where the economic demand pressures are quite muted. And that is also reflected in core inflation, which in the month of July was around 1.6%. That tends to have an impact even in the overall headline inflation print. Looking at some of the other sub-indices of inflation, food inflation, has started coming down, closed at around 6.6%. That is in the month of July. And fuel inflation closed at 8.6%. That is in the month of July. We expect it to be more or less within this range. We expect it to go upwards, but not as acute as what we saw in the last 2 months. Basically, we've seen a normalizing in the global oil prices, and that tends to impact even the fuel inflation. Our general expectations of fuel of the inflation trend for the month of August should be around 4.5% to 5%, and that is within our expectation for the current quarter. Moving on to the next slide, what we expect to what is expected to be released today is now the unemployment rate, and this is for the second quarter period. And I've shared even the trends for the last 2 quarters, that is the fourth quarter of last year and the first quarter in this year. And what we saw in terms of the first quarter numbers, labor force participation. So basically this is labor force. Labor force is now all those people who are employed and also unemployed. For the first quarter, that number was around 18.7 million, and the participation of and the population between the ages 15 years to 64 years. This is ideally the population that is tracked in terms of labor statistics. That was around 27.3 million. So the labor force participation is basically that 18.7 over the 27.3 million. That gave us 68.7%. And now we look at employment over the population. This is basically in the first quarter, the people who were seen to be employed was around 17.8 million. So 17.8 over the 27.3 million. It's giving us an employed to population rate of 65.3%. And then we have unemployment rate, and this is the key data in this report that you expect to come out. For the first quarter, the people who were unemployed was around 914,000, of which as a percentage of the labor force, the 18.7 million, that came to around 4.9%, and that is what is critical. So second quarter, we all remember how, because of the COVID-19 pandemic, it had an impact in labor statistics. In particularly some key sectors, think bars and restaurants, think of aviation, think of tourism. So those sectors were largest hits. And also a number of other sectors had hits. So what to expect even once this, with the upcoming release of the second quarter unemployment rate, we could either see the unemployment rate shoot up, or we could say the inactive population. Inactive populations are people, and in particularly in reference to COVID-19 period, are those people who lost their jobs, those people who are retrenched, or people who operate in businesses, and because of the diminished opportunities, they are not able to pick up. So those ones are reflected under the inactive population. So we're likely to see that number spike up from the 8.5 million that was there as at the end of first quarter. So that is something that we should be looking out for in the course of the day. And why am I bringing particularly these two statistics? That is the inflation and the unemployment rate. In other markets, particularly in the US, they keep track of the inflation and unemployment data as part of the Federal Reserve's key interest rate decision, and that is what is called the dual mandate, based on those two key metrics, inflation and unemployment. In the Kenyan context, however, primarily CBK keeps an eye on price stability, and that is inflation, and of course, there's that financial sector stability. So it doesn't explicitly keep track of the unemployment rate. But because also inflation or because of the interest rate level in an economy can also somehow dictate even the kind of economic growth. So we find that even unemployment rate data is something that somehow they can also keep track of indirectly rather than directly. So overall, even these readings that will come today will be factored in even once CBK meets at the tail end of next month as it has its monetary policy committee meeting. Another statistic that will be released on Thursday is the Purchasing Managers Index. This is basically a pulse of the private sector business sentiment. For the month of July, that print was around 54.2, up from an average of 39.7 in the second quarter. So we'll be keen to look at how that trend picked up in the month of August. Moving on to fixed income segments, just for the benefit of those people on the call who perhaps don't know about T-bills, this is the slide for them. The minimum face value to invest in T-bills is 100,000, and then with multiples of 50,000. You need to have an active CDS account, and primarily T-bills are called discounted securities, and it's basically because they are priced at a discount. For instance, the 91-day T-bill, the yield from last week's auction was 6.273%. So ideally, you'll be paying for every 100, you'll be paying 98.46. And then after the end of the 91-day T-bill, after the end of the 91 days, that's roughly 3 months, you'll receive 100. So that difference is what you'll be able to receive. That difference is that difference between 98.46 to 100 is now the interest which you'll be receiving. And the price might be slightly higher than the 98.46 because of the tax component that you'll also be able to pay at the front. So you'll get a lower interest, or rather you'll pay a higher price than the 98.46 to get 100 after 3 months. The same goes with the 182-day T-bill, which as at the end of last week, it was 6.625%, but in actual pricing for every 100, it's 96.82. And 364-day T-bill, last week's yield was 7.507%, and the actual price you'll be paying is for every 100 is 93.04, which you'll receive 100 at the end of 1 year. So principally, that's how T-bills work. Discounted securities, as opposed to how T-bonds are, whereby you are receiving semi-annual coupons, or rather you're getting interest every 6 months. So let me just run down how last week fixed income market was. On the secondary market, the T-bonds activity, we saw that that turnover jumped more than triple to a high of 24.5 billion. That was a 59-week high. We've never seen a weekly activity this high the last 59 weeks. Primarily, this was driven by trading in the infrastructure bond that was started trading in the course of the week, which occupied the lion's share of the week's activity. On the T-bill segment, the weekly turnover was 12.6%. CBK usually comes to seeking 24 billion on a weekly basis, just received 12.6 billion. That's around 52.3% performance rate. And yields across those 91-day T-bills, 182-day T-bills, 364-day T-bills on average went up by 0.02%, or 2 basis points in more technical terms. Right now, the net domestic borrowing is at 218.5 billion, because CBK was not able to meet the borrowing target for the week. That even had an impact of slowing or reducing the net domestic borrowing. As at last week, we were around 221 billion. So this week, we came off to 218.5 billion. And if we include the CBK overdrafts, which CBK has been picking, that is around 200 billion, 200.2 billion shillings. Just a commentary on the liquidity trends. Last week was the first time in over 4 months that we saw CBK coming to inject liquidity. Basically, on a daily basis, CBK just looks at what is the liquidity trends in the banking sector. And Monday and Tuesday last week, it was the first time that CBK was coming in to inject liquidity, because all along we've been saying that the banking sector has been quite liquid. And come last Monday, Tuesday, that wasn't the case. So they came in to inject liquidity on 2 different occasions. On Wednesday and Thursday, they didn't participate in either injecting or mopping liquidity. And on Friday session, CBK came in to inject liquidity in the banking sector. So all this is just telling us that perhaps liquidity that was there, that even drove yields to record lows, particularly in the month of July, is somehow normalizing in the current market. That was also has been reflected by the fact that interbank rates has spiked up gradually. Right now, I think it closed last week at around 3%, the average interbank rate. So just commentary on the week's trade. We still expect that activity will be on the infrastructure bond that was listed last week. That is the 11-year infrastructure bond. And the implied yield on that paper, on that bond, is around 11.17%. So we are recommending buying it within 11.15% to 11.2%. That's our recommendation for the week. Let me just stop it there and call upon Daniel to take us through the Q&A session. Daniel, over to you.
Thank you very much, Churchill and Gerald, for the presentation. Now we head to the Q&A session, where we have received a question from Eric, who's first saluting you for what you've done and asking what is your outlook for the bank revenue in 2020? And then you have a forecast of 29% drop on banks' half-year profit. What is the outlook of the full-year profit? And then the third question is the quality of provisions satisfactory, and is the level of the provisions likely to increase? Over to you, Gerald. I think you'll be able to handle this.
Yes, Daniel. Thank you, Eric. So in terms of revenue outlook this year, I think it will be generally in line with what we have seen so far. Interest income lines are expected to be depressed. I think there's not much lending that is going to happen this year. And given that that is one of the areas that usually moves the interest income a lot, then I'm still seeing a depressed interest income line growth. For non-interest income, I think most of the banks have announced either zero or negative growth in that area. And given that CBK extended some of these measures that were basically bringing on board free transactions, then it will be expected to be more or less the same that we have seen during the half-year period. So profitability, this is again going to vary. What we have seen is that some banks decided to take provisions now rather than postpone to the later quarters. I think it is the recent one was ABSA talking about taking COVID-related provisions now rather than postponing them to the future period. And given that some other banks have been moderate or conservative in terms of taking provisions, then I think I think they may have to increase their provisioning levels during the year. For the quality of provisions, yes, I think I'm okay with the banks that went aggressive on provisioning levels. I think so equity about 600, 700% increase, ABSA about 250. Those I think are okay, but some other banks will have to take much more provisions than the previous than they have so far in the half-year period. Thank you, Eric. I hope that answers your questions.
Yes, Eric, you can kindly confirm this. And Crispin has asked for Churchill to remind him of the tenure of the current infrastructure bond and what is the taxation structure on it. Churchill?
Thank you, Daniel, and thanks for the question, Crispin. The current tenor of the infrastructure bond, that is 11 years, and for all infrastructure bonds, it's a tax-free instrument, so you don't pay any tax. And just to compare with other kind of bonds, government bonds, whereby if it's 10 years and below, if it's below 10 years, the tax rate of that is 15% on the coupon, and if it's up 10 years and above, that's 10% withholding tax on the coupon that is has been offered.
Okay, thank you very much, Churchill. Stephanie Odundo is asking, what is the minimum investment for the infrastructure bond?
Like any government bond, that's 50,000. That's the minimum investment at the primary. That is at the primary market. The primary market already happened with the auction that happened 2 Wednesdays ago. So right now at the secondary market, it's now upon any investor. You can bid in whatever amount that you have. But just to put it out there, for the odd lot book is in the fixed income segment is any amount below 50 million, and those ones which trade in the main book is anything above 50 million. So secondary market, any amount that investor has. At the primary, the minimum is 50,000.
Okay, thank you very much, Churchill. Kevin Safari is asking, what about gold and precious metals? Is there such trading in Kenya? He's aware of ABSA Gold. Gerald?
Yes, thank you, Daniel, and thank you, Kevin. Yes, ABSA Gold is a security that currently trades at the NSE. It is an ETF, as you may know, and an ETF is basically a security that has underlying, in this case, the gold, and which so usually moves in tight correlation with the price movement of gold in the global markets. So again, for that is a security that you can easily access through the Nairobi Securities Exchange. For other commodities markets, products, I think we have a partnership with FXPesa, and they provide a platform where you can trade all the commodities that you can that can be tradable on that platform. So that is something that you can definitely venture into. Thank you.
Yeah, thank you, Gerald. Another question for you, Valerie is asking, could you kindly go through your recommendations on the shares trading again?
Yes, so I can, yes, for this week, we have two recommendations. One is Safaricom. We still maintain our profit-taking recommendation because the price has reached the resistance level of 30 shillings, and at that point we usually see a lot of profit-taking investors, and then come to push price down to about 27 shillings. And this has been the trend, especially over the most part of the year, especially under this pandemic. So it has been oscillating between that support price of 27 and resistance price of 30 level. So we expect it to still trade within that range. So the other is Centum. Yes, we are talking about speculative investors can look at it favorably. The price to book is about 0.3 times, quite attractive. And given that this information that could boost the price in terms of one, the majority shareholder taking additional stake, and also the guidelines the CMA issued in July in terms of share buybacks. And the company has been interested in this. Those two events could definitely push the price from its current level. Thank you.
Okay, we've seen 3 people have raised their hands. That is Lydia Awor, Rashmi Shah, and Dennis Atandi. I'll start with Lydia. Lydia, maybe you can unmute and ask your question live. Lydia Awor. Okay, maybe Rashmi, you can unmute and ask your question. Okay, maybe you can kindly chat us your questions instead of raising hand to make it easier for us to go through with this. Now, we go to the next question. Caroline Bugoiri is asking, do you consider TBills a good investment at this time? That is, I'll direct that to Churchill Ogutu.
Thanks, Caroline, for the question. I'll say that it's pegged also on investor preference, and primarily people come into T-bills as a way of quote unquote parking, that perhaps there are no opportunities that you're looking at, perhaps in either the T-bonds or even the equities market, and you just want to wait out the trend to play out in other assets that you're looking at. So in the current environment, as Gerald has alluded to earlier on, right now we're looking at strong with stocks with strong buffers to ride the current pandemic uncertainty. So we find that even in the current NSE market, that kind of opportunities are, you just limit to around 5 stocks, which most investors have. So you might find that you might either have a concentration risk in a few stocks as opposed to diversifying across, hence as a way to wait for this trend to ride away. You want to somehow pack the extra cash that you have into T-bills. So from that perspective, it is a good way. It's a good investment tool. You get the returns in the interim. Another thing to look at it in terms of the yields, we've seen that in the T-bills environment, between June all the way to July, the yields were coming down. And we saw on average around 1% decline across the 91-day T-bill, 182-day T-bill, 364-day T-bill. Right now, in the month of August, we've seen that trend reversing. So yields have started going up. So that means that you will get more of returns in currently as opposed to if you had invested a month ago. So those are some of the other factors that investors are looking at. That in terms of parking facility, T-bills is the way to go with, or even the money market funds or other unit trust funds, which are near cash securities. And if you want to returns in the current T-bills environment, this is also a right time, as opposed to a month ago when yields were on a decline trend. I hope that answers the question, but back to you, Dan.
Yeah, Elizabeth Mungai is asking, what percentage of your analysis is technical based and what is fundamental based?
Yes, thank you, Elizabeth. Most of our analysis is fundamental based because we believe that investors should be buying businesses, right? When you are buying shares in the stock exchange, you are buying a piece of a business. And However, despite mostly looking at fundamentals of a business, we usually use technical analysis as a way of looking at entry points, good entry points for for businesses that we have identified as good candidates for investments. And we also look at technical analysis for short-term trading opportunities, so that, for example, if you are talking about Safaricom today, at profit take Safaricom today, then we have looked at the technical analysis part of it, of the share price. So we usually use a mix of them, but we are mostly on the fundamental side of analysis. Thank you.
Okay, Ian Wangai is asking, what is your view on CBK having control over dividend payments by banks? And then I'll couple that with David's question, which is asking the Emakiba issue 2 had a redemption date of 20th of last month, that is July, and it has not happened yet despite the date passing. Was the date changed? Over to you, Churchill.
Let me let me answer David's question, and Gerald will pick the other one about dividends by banks. In terms of Emakiba, the redemption date is the Emakiba 2. The redemption date is next week on Monday. That's 7th of September. It wasn't actually 20th of July. Emakiba 1 redemption date was around April 2020, and Emakiba 2 was September 2020. So it hasn't changed at all. It's been September 7th. Gerald can answer the question about CBK and dividend policy. Gerald?
Thank you, Ian. Very, very good question. Yes, the Central Bank of Kenya, any regulator is pro capital at this point under the pandemic. So I expect them to be very tight in terms of what dividends the banking sector will announce, and most likely are going to see a cut in dividend, or entirely doing away with dividends for most of the banks. So it's one of the factors that we look to address in our subsequent coverage of the banks, because it is a key point, especially given that banks are usually heavy in terms of dividend payments, and it's surely one of the things that investors look a lot. But given that CBK is coming in to address this issue, then I expect dividend cuts for the end of the year. In our earlier report on the banking sector, we didn't expect the interim dividends, and I think this came through. I think for full year dividends, we had expected some banks to announce, but given now this new development, then definitely we're going to change that outlook, because it will have an impact on this. Thank you, Ian.
Okay, Gerald, a couple of questions directed towards you. Gaspari Kirudu is asking, which is the best non-banking NSE stock for both capital gain and dividends to retain for a maximum of 2 years? And then Felix Munyao is asking, what is your long-term view of Scan Group? And then Amani Wanjau is asking, what is your view on Kenya Re for the long term? And then Emmanuel Mureithi is asking, why don't Kenyan companies go for share buybacks instead of these penny dividends that they give us?
Thank you, Daniel. Yes, in terms of non-financials, I think there are a couple of strong stocks that are still remaining. We have EABL in mind. I think it's trading at good levels. Definitely there's going to be an impact this year because of the pandemic. Safaricom is another good non-financial. However, the disclaimer here is that I would expect it, I'd want investors to get it at price levels below 26, 25, or even better than that, because I believe current price is quite high and may limit your capital gains. There are others, stocks that were once very good, had very good fundamentals, but they have experienced some challenges either in the industry, even before COVID, like Mamburi, like Nation Media. But we are always looking at opportunities that investors can invest in. depending on how the industry dynamics are and changes in the business. So the two key for us is EABL, good price level currently. Safaricom, I expect better prices than what we are seeing currently. And also Kengen, I think it's a good stock. Power for them in terms of generation is stable revenues despite the challenges that KPLC may be having. The other question was a bit long-term view of Scan Group. Well, Scan Group is not a stock that we usually keenly follow, so I would not be the best person to give you very good views in terms of how they'll be. But they had a transaction. I think that's something that is out in public. They sold a business that was contributing about almost over 60% to revenue and profitability. That is definitely going to have an impact on their performance. So I cannot go into much detail about that. It's not a stock that we keenly follow. But if you are very interested in this, you can always talk one-on-one. In terms of Kenya Re, is usually a very interesting stock because it usually trades at very discounted multiples. I think recently we looked, we had a recommendation on Kenya Re trading at below the net cash value per share. I think that despite the fears of most investors because of the government stake, the discount that the market usually gives Kenya Re is quite unwarranted. I think for the long term, if you are a value investor, it's a good stock that you can look into. In fact, in the recent financial results, they announced some very positive performance despite the current environment. So the last question was Emmanuel was talking about share buybacks. Yes, I think share buybacks is something that has been there for markets, for developed markets, but it is just recently that we have the CMA providing guidelines in terms of how companies can execute this. It was just in July that they gave guidelines for execution of share buybacks. So it's something that companies can now venture into. However, there has been discussions about share buybacks all over, whether they are good or bad. Currently, the stories, they are not good because of the current pandemic, and most of the companies that are doing share buybacks are now, requesting for public funds for bailouts. But I think it's one of the positive things that can happen to our market to also boost the share prices of discounted counters. So thank you, Daniel. Over to you.
Thank you very much. We also received feedback from David Tolle, who was talking about having a portfolio example showing weighting based on bonds, T-bills, and equities for the group. Now, we have at Genghis Capital, we have the Genghis playbook, which is released at the start of every year, and we will share it in the next session, a preview of it in the next session. I believe Churchill and Gerald can organize on this, and it basically shows you the stock pick combinations, which you can be able to buy depending on your risk level and depending on your risk level. And other than this,
Dan,
yes?
let me just chime in at this point.
Yes.
In terms of, we run portfolios on the equities and also on the fixed income. On the equities, we have, at the beginning of the year, we had 3 portfolios. We had the momentum portfolios, which basically as the liquid stocks. We have income portfolios. Ideally, those one were tracking the companies which consistently pay dividend. The benchmark was a dividend yield of at least 8%. And we had the growth portfolios, whereby those stocks which had that capital gains potential vis-a-vis the other listed companies. Based on that, right now, we are just looking at the momentum. Just looking at the fact that most companies are not paying dividends, so we've not been actively coming up with an income portfolio. So right now what we have is momentum portfolio, and just looking at against the performance vis-a-vis the benchmark, the NSE 20 and NSE 25, it's consistently outperformed the benchmarks. Moving on to the fixed income, we have a Genghis Capital fixed income portfolio, and that compared to the FTSE NSE FTSE Kenya Government Bond Index, it has also outperformed it by around 0.2%. The thing is now, and that is a challenge that David has now thrown to the team, is now to put it in terms of a weighting the asset classes between equities, fixed income, and then looking at it. We had conversations with institutional clients that are the fund managers, and just based on that, because they're the ones who run or actively manage client money. And based on our conversations with them, they are biased towards the fixed income segment. Why? No brainer. The current environment, there's no risk reward measure getting into the equities. So they are heavily biased towards the fixed income. Just to give you a flavor of what our institutional clients are doing, and something that also perhaps retailers or other clients can also be emulated. But the feedback has been quite noted. I think the next webinar we can delve on that issue so that our clients can be able to understand better. Back to you, David, Daniel.
Yeah, Kevin Wabungo was asking where we can get this information of the portfolios we are talking about. Maybe Churchill can handle this.
On the weekly, we usually have, if all our investors receive our Genghis Cross Asset Weekly Report, we put it in a tabular format, that's on the equities, and then on a graphical format on the equities performance, portfolio performance, vis-a-vis also the benchmarks. And also there's a chart showing our Genghis Capital fixed income portfolio performance on a year-to-date basis vis-a-vis now the benchmark, so that we put it on our weekly reports that clients can be able to refer to.
Okay, thank you very much, Churchill. And we have also received feedback on the investor educational content, which could be used for young investors who do not understand much about what is being talked about. And I'd like to point you first to maybe our YouTube page, where we have some of the videos that of these webinars that have happened before. And as we are talking, Crispin has asked for us to describe Genghis online trading platforms. Now we have an application called Jikuze mobile app. It's currently on your screen, which enables you to not only trade in equities, but you can also buy and sell unit trust. That is also another, you can be able to download it from the Google Play Store or the Apple Store and create an account, after which you'll be able to buy and sell shares in the Nairobi Stock Exchange. And then other than this, I think we can end this session here. And thank you all for participating in this webinar, and see you next time.